Hey everyone, me Kevin here. Okay, let's get right into the skinny of the FOMC minutes. So far, I'm actually surprised by this. It's better than expected. I thought there was going to be a lot of dissension in the minutes about like almost a fight brewing between Fed members arguing that we need a hike and others saying we need a pause. We didn't get any of that. Pretty much everybody's like, yeah, okay, let's see how the lags impact the economy over the next month. Let's get through that July 12th report and let's just go ahead and pause. Even though some would have preferred to have hike 25, they all agreed that a pause was acceptable. So it sounds to me like you've really got a Fed that's sort of like, we've done so much so fast. We're okay being at 5 or 5.25. 5.25 is probably most likely, or 5.5, and we can take between now and the end of the year to get there. We're really just in that fine-tuning stage. Regarding the actual minutes, when I go into the minutes beyond that observation, they do mention that the market expectation is that there will still be some form of a recession, though it seems like the Fed is trolling a little bit here because the Fed still says, and again reiterates here, but the expected timing was again pushed later. And this is kind of a slam on the analysts who just keep saying, oh, it's going to be a recession Q1 23. Oh, no, it's going to be Q2 23. Oh, no, Q4. Now it's like Q1 24. We just keep pushing the recession back. It's constant. So the Fed does think that credit tightening is going to lead to a, quote, mild recession starting later this year, followed by a moderately paced recovery. However, even that mild recession argument from the Fed is probably going to get delayed. You've already heard Jerome Powell delay his recession expectation, and even though he, a couple months back, mentioned, oh yeah, we're probably going to have a recession, he's now removed that, and now he's argued, maybe we're not going to have a recession. So he's on that line, he's teetering. Regarding inflation, we expect that the Fed here expects that housing inflation has peaked and core non-housing services is projected to slow gradually. This is really important because Jerome Powell's made it very clear they're willing to wait basically until 2025 to get inflation back to 2%. A lot of the bears today are arguing, oh, well, we're still way higher than 2%. So? By the way, quick note, I'm in Arizona. It's like 110 degrees out here, so forgive me. I'm in a t-shirt and shorts here. We are bringing back the shadowing program, so if you want to shadow me, click the link down below. You can follow me around as we explore real estate for House Hack. Click the link below for more details, next to the link for the coupons on the courses, link below. Okay, so nominal wage growth eased further, and eventually this softening in wages will lead to a softening in core inflation. Let's see. Staff saw the possibility of the economy continuing to grow slowly and avoiding a downturn as almost as likely as the mild recession baseline. So it's really a coin toss, that soft landing scenario playing out. You've got full effects yet to be realized for the tightening. We already know that. I did think it was very interesting that they've thrown in this argument here that the housing market, at least tentatively, with low inventory, has started to show signs of, quote, bottoming out, with home sales, builder sentiment, and new construction all improving. Now, that's good, by the way, builder sentiment and new construction all improving. We need inventory in real estate. I mean, I'm out here, and it's sort of like slim pickings to find real estate right now, but that's okay, because as soon as inventory starts going up and rates are higher, there are going to be some sweet opportunities to buy real estate. So you really got to perfect where you want to buy now, so you're ready to strike probably beginning of Q4, beginning of Q1, and just slowly ramping into the market is our expectation right now. I think there are going to be plenty of opportunities over the next 5 years, frankly. There won't be a shortage of opportunities. So more from the Fed. So let's see here. Okay, we talked about the lags, talked about continuing the pace of the balance sheet runoff. We've got 0 mentions of Russia, 0 mentions of Ukraine, 1 mention of COVID. Market reaction, very muted right now. You're really not seeing anything. The hawks on the FOMC wanted to raise rates, but they ended up agreeing with the pause. We talked about that. Let's see here. No real foresight in this in terms of what might come in the future. We just really have to lean on what we've previously heard from Powie. All participants judged it as appropriate to pause. That unanimity is actually phenomenal that Jerome Powell's been able to pull this off. Treasury yields not really moving much. You've got some, again, the quote, so you have it, is some policy members favored raising rates, but ended up agreeing with waiting 1 month. Powell still thinks he can pull off a soft landing. Here's some Wall Street commentary on this. Looking at back to the actual commentary from the Fed of items that I've highlighted, you've got still this uncertainty around the banking crisis. I would vastly argue that the banking crisis is mostly over. Well, I mean, I suppose it depends, because if Treasury yields do trend up more, then that's going to end up hurting bond values, which actually hurts the banking crisis more. And that's probably why you've seen some of the buy the dip funding program. It's not actually what it's called, but that's probably why you've seen some move up in yields, potentially be another risk for banks. So I'm looking, just refreshing right now. The 10-year actually is starting to jump right now. That's actually quite interesting. The 10-year is up 8 basis points now. You're at 3.94% on the 10-year. That's your headline right here, is the 10-year jumping. We're almost at a 4% on the 10-year again. That actually does increase the risks of putting pressure on these smaller banks again in the banking crisis issue we had in March. It's all driven by these higher rates. Higher yields means a lower portfolio value, more borrowing necessary. So more bank failures could come. So far, it's been a nothing burger, but we were also expecting yields to trend down as inflation was trending down. Now we've got inflation trending down and yields just rising. It's totally the opposite of what you would have expected. So a little bit bizarre. It does look like, even though the market initially reacted neutrally, I mean, the Nasdaq's down 11 pips, it has slightly trended down, so it's teetering. There's really little movement here other than in the Treasuries. Treasuries does increase the risk of breaking something, though. And breaking something is where, excuse me, the Fed breaks something, that's usually where you start pricing in Fed rate cuts again. Remember what we had during the banking crisis. People were expecting 1.7% in cuts. Right now, the market is expecting 25 BP in the next Fed meeting and no cuts until March at the earliest of next year. So really, just higher for longer, economy continuing. But in terms of any kind of secrets here in the minutes, I'm not seeing anything really scary. What I did like that I highlighted, I said the unemployment rate is forecast to increase this year. JPM argues September. The Fed is thinking some point this year we're going to get the unemployment rate rising a little bit. This Friday we're expecting it to be 3.6%, down from 3.7 where we were last report, but that was up from 3.5. But anyway, that unemployment rate decline is expected to continue until 2025, after the unemployment rate peaks in 2024. So I would guess around the time of a peak employment rate is probably when the Fed expects to start cutting, once they're convinced that core inflation has fallen. Market-based policy rate expectations rose notably, right? We're pricing in basically the next 25 BP, and the Fed is acknowledging that. So far, everything's relatively consistent here. Let's check the futures market for the FOMC rate projections. This morning we were about 88% certain we were going to get a 25 BP here. We're still right now at about that 88%. And if we look at the 5-year break, I don't know that we're going to have any movement on this, but let's do a quick check. 5-year break even this morning was rising. Still at 2.23, stable up. We were sitting around 2.1, 2.12. Prefer to stay around there. So stable up right now. But that sort of aligns with what we're seeing in the bond market with Treasuries trending up. Treasuries continuing up. The 10-year breaking 4% and this sort of steepening of the yield curve could put more pressure on the banking system. So that's your heads up. Like if you're still in the super small banks, maybe diversify within your FDIC limits. Knock on wood, not trying to create any kind of FUD or fear or whatever, but the banking crisis could easily renew itself. There were plenty of other banks that were really close to failure, and then everybody kind of forgot about them. And that could absolutely reignite. I mean, consider this for a moment. You should really look at this. Just go to CNBC.com, click on the 10-year, look at the 1-year. for the 10-year Treasury yield, and you were last at 4% right before the banking crisis. We're basically right back to that, and then you were there around November and October of last year. That's when House Hack bought a bunch of Treasuries, which obviously we're now looking for real estate for. So, anywho, check out the links down below for the courses and the shadowing program. And if you previously were involved in the shadowing program, we can lock you in at the same price that you previously had. Just email us at staff@meetkevin.com since we're bringing it back. Thanks so much for watching. But otherwise, I'd say broadly, this is mostly as expected. This is good news. One more look at what Wall Street is saying here, because you don't want any kind of rug pull here. Participants generally judged growth would be subdued. They've been saying that for 2 years. Minutes were right in line with expectations. Exactly. Yeah, that's it. Anyway, thank you so much for watching, and we'll see you in the next one. Goodbye.